Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Mark Marex, Head of Index Research Americas at Nasdaq, as well as Ryan McCormack, Senior Director of Factor and QQQ Equity Product Strategy at Invesco. We're here to discuss how R&D metrics can be useful for investors in identifying many of the most innovative companies in the Nasdaq 100. It's great to have the both of you with us as always. Mark, as you know, this is one of my favorite topics because we see these investments translate into growth, which translates into the performance of the Nasdaq 100.
Yeah, sure, Jill. I mean, it's what a time to be talking about the ROI on R&D, right? Like everyone's talking about where is this AI trend going to end up? We're seeing it in the fundamental results of a lot of these companies that are R&D champions year after year, blowing away expectations, right, quarter after quarter. This quarter, in fact, we're on track for over 30% earnings growth in the Nasdaq 100, about triple the rate of the broader S&P 500, right? So that kind of begs the question, what is enabling that level of outperformance? And in the empirical work that we've done in-house at Nasdaq over the years, we've established that very clear relationship, especially around the last 10 to 15 years. When you look at all companies globally, the ones that tend to spend the most on R&D, not just in terms of total dollar amounts, but as a percent of their revenue, right? Think of it as an R&D reinvestment rate. Those are the companies that are growing their top line 3 to 4 times faster than everybody else. Those are the companies that are seeing their stock prices appreciate 3 to 4 times faster than everybody else.
Yeah, and Ryan, it warrants the multiples that you're seeing.
Yeah, I mean, I think the story is one where it's, you know, we say innovation, but R&D and intensity in terms of intellectual property helps to drive fundamentals, and ultimately fundamentals is what drives price. And you look at this quarter, you know, you have 92% of the Nasdaq 100 have either met or exceeded earnings expectations. You're tracking over 30% growth. Those are very real numbers, and I think when you're looking for growth in the market, it's very clear that, you know, you look at the subset of 100 companies and it's consistently delivering. We've seen it for the past 10 years, right? It grows revenue, earnings, and even dividends faster than that of other large cap competitors.
Yeah, and they're taking up CapEx, which of course includes R&D, so they're continuing to invest.
100%. And I think, you know, the work that Mark started and we use and talk about frequently would be, you know, you look at kind of the patent intensity, right? You see trends like NLP or speech recognition and chatbots, big data. I mean, the Nasdaq 100 files over 20% of patents relating to all of those themes for the past kind of 12 months. But, you know, this has been going on for years. So these are long-term investments, this kind of commitment to research and development, this commitment to developing intellectual property. And I think it sort of tells the story of why these companies have been able to seemingly stay ahead of the curve when it comes to changing trends like cloud, like AI. I mean, these are the companies that have won.
Mark, when you're looking at R&D metrics, is that a standalone selection criteria, or are there things that you should be looking for that could potentially be a drawback?
I mean, look, you can certainly try to build indexes, try to build investment strategies around R&D as a standalone metric. What we find in the data is that most of the time, right, something like R&D spending and patent filings are highly correlated, right? If you're spending a lot on R&D, it kind of makes sense that you're devoting at least some of those resources to patent development, but it's not a perfect one-for-one correlation. So in the work that we've done, the analysis that we've done on indexes like the Nasdaq 100, what we tend to find is that when you're looking at R&D, it's really the intensity that matters more so than anything else, right? It's not enough in today's, you know, hyper disruptive, globalized innovation economy to spend a little bit on R&D and think that you're going to see big payoffs, big dividends off of that. You really have to be sort of in that top quartile, that top 25%. In terms of rankings relative to your competitors, R&D as a percent of revenue, to see those kind of exponential gains in terms of fundamental growth and stock price performance. That's what we've seen in R&D. On the patent side, it's a little bit different because it's a little bit tougher to measure, like a single patent, what are the dividends that you're going to get from filing and developing that one patent versus another patent. It's a little bit more qualitative. It's a little bit more opaque in terms of knowing how much money went into developing and defending that single patent. So we've seen a little bit more of a, I would say, an either-or relationship there, where companies that are filing at least some patents consistently over the years, they're the ones that are seeing the earnings growth, the revenue growth, the outperformance in the market, versus those that are filing no patents. They're definitely underperforming. They're seeing their top lines even shrink over time, and their stock prices are suffering as a result. There's not as much of a clear relationship between the ones that are filing the most patents by far versus the rest. It's a bit of a different relationship.
Yeah, and Ryan, especially with technology, even when you think about Moore's law and just surpassing it, it's evolving at rates where we might even be talking about something completely different, 6 to 12 months from now.
100%. I mean, and I think that's what's interesting. I mean, you look at the patent filings, and as Mark had said, right, it isn't just blindly filing, but you can start to see trends where a new technology starts to emerge on the table. And I think that gives a very interesting lens into where companies are expecting future fundamental growth to be derived from. I mean, it comes as probably no surprise that we've done some work looking at just GDP and kind of where the economy is going. And Mark and you on the show, of course, have talked frequently about how Nasdaq is representative of the 21st century industrials. But you look at sort of the growth of GDP components, and intellectual property products has doubled the next highest area of growth over the last 20 or so years. Much faster than non-residential equipment, faster than non-residential structure, residential, even government. It's more than 2x the next closest competitor. So you're sort of seeing that drive kind of the fundamentals, right, from an economic standpoint, but also from just a stock price performance, looking underneath the hood and saying, well, IP is becoming a very clear designation of being able to win and drive that growth.
Mark, outside of technology, other sectors where you're seeing significant R&D spend?
Yeah, I mean, it's by and large the sectors that are overweight, overrepresented in the Nasdaq 100. So I think it's tech by a mile, right? But also certain parts of consumer discretionary. A lot of people assume companies like Amazon, Tesla, Netflix are tech companies. At the end of the day, they're actually classified as consumer discretionary, right? So there is this sort of tech slice of consumer, and then within healthcare, obviously biotech, right? Biotech basically runs on R&D. The whole business model within that subsector of broader healthcare is driven by innovation and R&D. So those are sort of like the three heavy hitters in terms of highest level industry, sector level focus on innovation. But I want to go back to something that Ryan was hitting on earlier, which is, when you think about where the economy has gone, especially this century, right, the last 2.5 decades, you compare it to what the world used to look like, what used to drive growth in the 20th century, I think in large part was growing the pie in the US and globally. You had strong population growth. You had liberalization of economies like China and Russia that were really closed off for a long time in terms of global trade. You had this opening up of the world, and you had a growing pie for everybody that was kind of supported by this underlying growth of population as the main driver. So it was easy in most sectors to grow and become more profitable and deliver good performance to your investors simply by positioning yourself as that pie was growing. This century, it's a completely different story, right? Major economies are closing themselves off, including the US to some extent. A lot of major economies are not seeing population growth, including previous champions like China. So you've got a pie that in many ways is shrinking. So as a company, how do you grow your top line and your bottom line? You have to innovate. You have to come up with something new, whether it's a product, whether it's a service that people are willing to not just buy more of, but pay a premium for. That's what the Nasdaq 100 does better, I would say, than most broader large cap benchmarks, focusing on the companies that have solved that dilemma, how to grow in the 21st century by focusing on innovation.
Yeah, well, NVIDIA would be a great example for that. I mean, they really are the X in terms of powering these emerging technologies.
Without a doubt, right? And I think now you see sort of this extension of, it's not only NVIDIA who, obviously the earnings coming up on the 27th, it's must-watch TV. I mean, that is the earnings report now. Yeah. But, you look at emerging competitors like a Broadcom, right? I mean, it's who's powering this whole new wave of emerging technology. And obviously, I'm not the first one to say that the semiconductor industry has certainly been one that the market has watched. But without a doubt, NVIDIA has been kind of the champion of all of that.
And it's so interesting, Mark, because you were talking about how these different sectors were growing, and Ryan had just mentioned that NVIDIA is must-watch TV. I mean, if you think about it, 2.5 decades ago, a company like FedEx would have been must-watch TV because that was an indicator of where the economy was going just based on shipments and consumer demand and so forth. So that's a great example of showing how that shifted.
Or GE, right, which no longer exists as a single company because they got too diversified and took on risk in too many different areas and found actually a lot of these areas are not working in sync any longer in terms of generating overall at the company level the types of growth that investors got accustomed to from the likes of GE back in the 90s and early 2000s, or even someone like an ExxonMobil, right? I mean, oil is not the end-all, be-all in terms of a measure of economic growth anymore because there's so many other different forms of energy now, so many different ways of replacing or complementing fossil fuels, right? The renewable energy transition, that even something like an ExxonMobil, right, is not an obvious way to play economic growth in the 21st century anymore. Of course, the Nasdaq 100 doesn't have exposure, right, to fossil fuels and oil and gas, has a little bit of exposure to the types of companies like GE in the industrial space, but by and large, the ones that are trying to be a little bit more innovative, a little bit more forward thinking, and not so stuck in the past in terms of, how to assemble a conglomerate and how to maintain that business model regardless of how the world is changing.
Yeah, and Ryan, it's interesting to note too that the Nasdaq 100 doesn't include financial companies. And when you think about the pie, again, 2.5 decades before, energy and financials certainly had a much bigger part of that than technology, perhaps.
Yeah, I mean, without a doubt, right? But I think it's interesting to Mark's point. Like, it isn't oil and gas anymore. Now it seems to be data center build out and where people are positioned in the world of CapEx, right? I think like Microsoft is a really interesting example. I mean, over the past year, it seems like investors were watching every data point when it came to CapEx spend, what they were doing with their leases. But now it's, where does that kind of filter through? Well, how are we powering that? Okay, you look at the nuclear energy side, or going back to Microsoft, it's not just kind of the data center world. I mean, they're in the world of AI with their investment in OpenAI, but now they're also hosting other companies' AI capabilities through Azure. So it's interconnected. It's very interesting to see how a company like that has positioned themselves. But the conversation has changed wholesale from 20, 25 years ago.
All right, it certainly has. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.